Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We got 1 hour to go until the market close, and we are seeing selling once again for the major averages. Selling that's really accelerated as the day has gone on. We've just bounced off the lows here, but still, the Dow off more than 400 points, almost 1% here. The S&P 500 down 0.9%, and the Nasdaq Composite down 1.25%. Now, there were some new tariff threats today, so that perhaps seems to be lending to this, but there also, according to one guest we're speaking to today, perhaps is a bottoming process that's happening here.
Not at the bottom yet, a process though.
Yes.
Maybe you're getting there. It's interesting because we also got economic data today.
Yes.
You got an inflation print that I think you would characterize as benign. You saw jobless claims. They actually fell by 2,000 last week. Those clocked in slightly below consensus. But to your point, that is just all being overwhelmed right now by Washington and tariff talk and uncertainty.
Right. We should mention as well, there is now a threat of an impending government shutdown to pile on everything else. This morning on the tariff front, President Trump threatened 200% tariffs on alcohol, wine, champagne, et cetera, coming in from Europe in response to some tariffs that Europe has put on the U.S. in response to our steel and aluminum tariffs. So already a lot of tit for tat going on. I wanted to look at some other assets as well today. We've got the 10-year yield falling again, down 4 basis points, 4.28%. We have crude oil falling once again as well. It had recovered to some extent over the past few days, but now below $67 again. And gold futures have been pushing to new records again here.
Yeah, we just end too. Treasury Secretary Bessent gave an interview today. I thought those were interesting comments too, just as a sort of window into how the administration is thinking through all this. And his comments, they were interesting. In part, he said, listen, we're focused on the economy. We're focused on the long-term health of the economy, not these, I think he put it, little bit of volatility that we're seeing there.
Right.
Yeah.
I don't know if market participants would characterize it that way, although many of the strategists we've been speaking to have been saying, focus on long-term and try to stay calm. Just a little bit more under the hood here when we look at the sectors in the S&P. The selling is pretty broad-based today, which has not always been the case on these sell-off days, right? Or on the up days for that matter. Consumer discretionary, real estate, communication services, tech. So still pretty tech-heavy, but you got consumer discretionary and real estate, interestingly, thrown in there today.
All right, let's get some more perspective on this. For more on the latest market moves as the stock sell-off deepens amid Trump's latest tariff threats, let's welcome in now Marta Norton, the Chief Investment Strategist at Empower. Marta, it is good to see you. So it got another rough day in the markets here, Marta. I'm curious just how you're thinking through it. You know, are you now, Marta, are you adjusting how and where you want to be committing capital, or no, are you in that camp that says, hey, this is going to prove to be a relatively brief, rocky period that we need and will move through? How are you thinking through it? What are you telling clients?
Well, I think as we think about this period of time, I think it's justified in a lot of ways. And let me give you some context to that. So when we start off 2025, we have valuations that are high levels, not all-time high levels, not levels that were, what we saw prior to the 2022 sell-off, but certainly at the higher end. We also had earnings expectations that were very strong. And you could argue as you looked at what those earnings expectations were, as you looked at where those valuations were, there wasn't a whole lot of pricing for downside. There was certainly a lot of enthusiasm around the Trump trade. But what we have today is a critical piece of the Trump policy agenda really focused on an area that creates cost for companies and creates cost for consumers. So as we think about that, I think a sell-off that is realizing that there could be some cost to Trump policy, I think that makes a great deal of sense.
And Marta, do you think that the administration is making, clearly not to market participants, but what argument do you think the administration needs to make that this is potentially worth it down the road? What message does it need to send?
Well, I think that's a great question because I think the way the administration is looking at this, and maybe it's been clear to some, maybe it hasn't, is really a two-act play, where the first act is a real focus on tariffs and on levying these charges, maybe evening the balance with some of these other countries. And the second act is stimulus through the form of tax cuts. That second act, though, of course, is contingent on the legislative process, which is its own, rigmarole to go through. But I think the administration will be saying, hey, in Trump's words, we're going through a transition today, but we're going to have this sweetener down the line.
Marta, what are you seeing with earnings estimates for 2025? And would you expect those to get revised down?
Well, that is my expectation now. And we have seen some modest adjustments to earnings expectations. I don't think we've seen a meaningful adjustment. And as we're taking a look at where tariffs are hitting, both on a cost of goods sold perspective and then on a potential revenue perspective, as we think about retaliatory tariffs, I think there's really two ways that we could see earnings come down a bit over 2025. I think what the market is trying to understand is how serious is Trump about these tariffs? Because if they do go through, we are going to see those costs of goods sold move higher. We could potentially see the revenue come down, and that would mean earnings compression.
Marta, I'm curious about your perspective in particular, working at one of the largest retirement plan administrators, right, and managers, because a lot of people they're checking those 401ks right now, even though the sort of conventional wisdom is don't look at the 401k. I mean, what are you hearing from people? What are you seeing in terms of people getting alarmed on that front, and what are you telling them?
Well, you certainly do see on the margin a little bit more activity. So if you think about something that's a real flight to safety move in the retirement space, that's something like stable value, and you are seeing more interest in areas like that, maybe a touch less interest in those large cap areas that have excelled so much in recent years. That's on the margin. I would say most of the retirees in this space are doing, or most of the retiree savers are doing what they ought to do in the sense of focusing on the long term, staying the course. But of course, that capitulation is something that we're always going to want to keep a close eye on because it can be the exact wrong move.
Marta, the Fed decision next week. What do you expect there? They stay put, and then what?
Well, I think they stay put. I mean, let's go back to Powell's comments last week. His focus was not so much on the soft data, on the surveys, on the sentiment, but was really oriented around the hard data, making the point that the economy really is in a good place. And what he said repeatedly is that there's no speculation game here. They really want to see what the policies are. They want to see them in play, not just the tariff side, but also, the tax side and some of these other considerations before they decide how they're going to move forward on monetary policy. Now, I don't know if they'll have that much time. I don't know if growth and inflation are going to give them that much time, but I do think that they're in wait and see mode for now.
What do they need to see, Marta? What are you looking for to see? For example, a lot of the trepidation is showing up in the markets and in survey data, where you ask people how they're feeling, less so in that hard data, as you talked about. Where are you first going to be looking for it to show up, if it's going to show up in that hard data?
Well, I think there's a few things. I mean, as we think about Fed mandate, of course, it's inflation, it's the labor market. So I think they're going to be watching closely to see the trade-offs between those 2 points. Now, of course, as we got the inflation print, at least from a CPI perspective yesterday, that was an encouraging signal. But I think they're going to want to see a trend. If there's one thing that Powell says on kind of repeat, it's the idea of focusing on the long-term development, not the print-to-print moments in time. I also think they're going to be watching that labor market closely. And there's so many different ways that you can slice and dice that. You can be looking at the JOLTS data, the hiring, the layoffs, and then of course on the labor front, you can be looking at wage gains alongside kind of how the unemployment picture is shaping up. I think those are going to be their two pillars that they're watching. But of course, they're also going to be watching kind of how businesses are feeling and what the beige book is showing them as they get kind of real-time data from companies around the country.
Marta, we've been very focused in this conversation on the U.S. and for good reason. I am interested to get your take on what's going on overseas, because we've had people all on the show this week, Marta, talking about all the interest in Europe specifically and how folks are committing capital over there. I'm just curious to get your thoughts on the excitement about Europe.
Yeah, I mean, what a difference a few months make. In fact, if you compare the enthusiasm that we're seeing this year to really the past decade, it's really been a meaningful sentiment shift. I've talked to a lot of advisors who've really only relied on the S&P 500 and treasuries to form the bulk of their portfolio. So the idea that there's anything coming from overseas is a real new idea, I think, for a lot of people. But when you take a look at where valuations were, they are, more compelling overseas. They have been for the past decade. What we had was a lot of kindling, and we needed a spark. And I think we're seeing that spark, at least in the near term, with some of the expectations around defense spending, with some of the expectations around what's happening in China and the AI theme. There are still some headwinds, though. And I think we have to acknowledge that, whether we're talking about China and we're looking at the malaise that, is in the economy over there, or whether we're looking at Europe and thinking about this tariff threat and the fact that those could hit a lot harder overseas than they do at home. So I do think you need that valuation opportunity to make a good case for international exposure.
Marta, thank you so much for your perspective. Appreciate it.
My pleasure.
We're just getting started here on Market Domination. Coming up, we'll check in on some of today's top trending tickers, shares of Cloudflare among them. Plus, imported wine, champagne, and other alcoholic products from the European Union are the latest targets of President Trump's tariff threats. We'll get you more details and the latest from D.C. coming up at 3:30. Stick around, much more Market Domination still to come. U.S. stocks continuing to pull back amid new tariff threats from President Trump. The S&P 500 flirting with correction territory. Our next guest noting that markets are growing closer to tradable lows. Here with a technical eye on the market action is Fundstrat Global Advisors Managing Director and Global Head of Technical Strategy, Mark Newton. Are we there yet, Mark? I feel like the kid in the back seat.
I think we're getting close. Obviously, it's very difficult to try to putt a golf ball down a flight of marble stairs and order it to stop and go back higher, right? But it can happen. So there's certain things that need to happen. We haven't seen any capitulation yet. I don't know that that is going to happen, but we've seen VIX inversion, for example. Yeah. Like the spot VIX is trading 7-8 points above 3-month futures. That's one sign. I also look for abnormally high volume to the downside that creates what they call a trend reading or the ARMS index above 2.5. So that indicates severe selling pressure. Normally the VIX can be up near 50. This time, interestingly enough, it's actually down a little bit than it was earlier in the week. It traded up to 29.5, and as of an hour ago, it was around 23. So we are seeing some divergence there, and sometimes the VIX can turn before the market bottoms and getting closer. So I sense that we're close. Seasonality and cycles both suggest that markets should bottom sometime in March. That's interesting. We have seen this largely be fairly orderly and concentrated in technology and financials up until the last week. Then we saw the Dow break January lows, the equal-weighted S&P broke down, so that caused a little bit of acceleration. But interestingly enough, the breadth levels are still above where we were back in January. So you notice at that time that the percentage of stocks above their 50-day moving average, for example, traded around 10%. Now it's up. It traded last night, it was at 30%. So there are fewer stocks that are, trading down. There actually is a fairly healthy amount of, surprisingly enough, rotation happening. And the defensives have held up. Healthcare has been better than expected. Tech, of course, where the largest degree of concentration has been very hard hit. So that remains an area of focus for a lot of investors. It drives the indices and is a reason why stocks are down 10% from all-time highs and down 5% very quickly year to date. But we were just at all-time highs literally 16 trading days ago, back on February the 19th, which is crazy. So this is unwound very, very quickly. And many people are wondering, is this mean we're going into a bear market? And I would say this is still a cyclical correction as part of a lengthier bull market. This type of seasonality is normal when a new administration takes over, and not to be critical or pro politics of anything, but anytime you switch an administration, the first quarter is rocky, and the first term of a presidential year, that's the time you normally get the consolidation and the sell-offs. So this has been honestly like a garden variety correction. We've had about 8 of these in the last few years alone, where markets are down anywhere from 7 to 10%, and granted we're at 10, but sentiment has really gone off the charts bearish. You're seeing CTAs having pulled back and they're short. AAII data shows about a 40% spread between bears and bulls. It's only happened twice before in the last 2 decades. That was 2022 and 2009, following a 40% decline in stocks. And so obviously all this discussion about tariffs daily is getting the consumer fairly negative. And I think it's the off again, on again that to some extent you could argue is harmful. Like we want to see a firm opinion and then we can sort of work around it. But to say it's off, it's on, people don't know how to plan for that, unfortunately. Yeah. So it does affect consumer sentiment. My own thinking is if we see an end to the war, and there's talks already that Putin has agreed to Trump's terms, but they need to negotiate, so to speak, that could be something that could be interesting if it happens early next week. My own technical timeline is about a week to 2 weeks max of when this can fall further. And I think we're very, very close to a very decent low that should be probably the low of the next 6 months, not just a low that we bounce and then go back down through. So I think it's going to be a fairly substantial low. And, it's going to be right for investors to stay the course. But honestly, there's plenty of other things working. If you want to look at precious metals, they're doing phenomenally well. Gold at new all-time highs. Gold miners doing very well. Those are areas that we've suggested to clients. Like, if you're growing impatient about tech stocks bottoming, there are plenty of things that are working well.
Right.
It's just not NVIDIA buying as it goes down every day. So unfortunately, you have to look elsewhere for diversification, as well as Europe and abroad, with the dollar having pulled back. There's a lot of opportunity in EM now that hasn't been present. The U.S. has been an interesting underperformer to start the year, and so China's done well. Europe has done very well thanks to financials. I don't sense that can last forever, but for the near term, that is still something that's working.
You mentioned tech. Here's a tech name I would love to get a technician's take on. Apple. What are you look at the charts of Apple, what do you see?
Well, look, Apple has been the quintessential safety stock really in recent months, and that took a turn for the worse a couple of days ago. So Apple's break of 219 was technically bearish, and I wrote to clients that we see it going to 210, and it's almost there now. So we did see, a breakdown on a short-term basis, but similar to many tech stocks out there, the intermediate-term trends are fine. It's more just short-term weakness. Tough to think that Apple won't be buyable within a week. I do like buying weakness in many of these technology names. I don't sense that technology did not see any meaningful degradation of earnings. So, the earnings data was taken down from 26% in terms of profit for this year to about 25%. So the earnings revisions are still showing that tech is going to be the biggest area of profit center for 2025. But tech is now down almost 15%. Some of these stocks are down 20, 30% or more. So, I sense there is going to be opportunity. They're finally down at levels that make sense to buy from a valuation standpoint also. Like the recent data showed that they're now below, the average of the last 5 years. So all of a sudden, valuations are in line. Companies are still making money. The earnings are there. Yes, 6 of the 7 Mag 7 did have revenue estimates that were taken down into the first quarter. But technically, these are still great stocks on an intermediate-term basis. And now we're in an environment where everybody hears tariffs every day, and they're starting to get very fearful. Normally, that's the time I want to buy. But you have to sort of dip your toes in the water. It's obviously sort of still a perilous type climate, where if you have a short time frame, then you have to tread gingerly, and you don't want to put all your eggs in one basket. And in a sector like technology, obviously, it's been going down for quite rapidly.
I want to come back to gold for a second. But for those people who are feeling nervous right now, if stocks are in the process of making a bottom, is gold in the process of making a top, or do you think gold, the gains it's seeing are going to be pretty sustainable here?
Well, I think sustainable for the next 6 months. We're still in a Fed rate cutting cycle. So, gold is less of an inflation hedge as it is just something where if the economy starts to weaken, rates really start to roll over like we've seen. I mean, the 10-year is down about 50 basis points in 2-3 months. So gold has thrived in that environment, and arguably now with recent data showing inflation starting to come down, the economy ever so slightly seeing issues of imports being pulled forward, that's affecting GDP, that's a great environment for gold and for silver, and I might add for copper. So for those that are worried about the R word, the so-called recession, copper's at the highest levels it's been in the last couple of years. It's going to move well over $5 a pound in my view. So March Madness is officially here and welcome, but that doesn't mean that there's no opportunity. There's plenty of things to look at that are actually working.
Mark, good to see you. Thanks for coming
Likewise,
in.
Joe.
Always good to see you. Thanks. Now, time for some of today's trending tickers. We start with Cloudflare. Those shares are dropping today as much as 7%. That's after analysts reduced their price targets on the software company following an investor day that it held. Analysts noted the company pushed back its $5 billion revenue target by a year, with UBS calling that move a modest negative. The shares have been rising over the past year. Unlike some of their software and cybersecurity peers, the shares are up about 19% over the past 12 months here. But analysts obviously a little cautious after what they heard from the company.
Yeah, UBS did cut that target on Cloudflare. They go to 135. They are on the sidelines. They maintain the neutral rating. Their colleagues at Mizuho, it looks like, also cut the target. They go to 140, also a neutral. They told their clients high valuation, prefer other high growth software names, Julie.
Interesting. All right. We're going to talk about another one, similar space.
You were so excited, you almost jumped
Sorry,
right in front of me. Our next trending ticker, Sentinel-1. That stock is moving lower today. It's after the cybersecurity company issued a first quarter revenue forecast Wednesday below street expectations. So security software name, under pressure, revenue forecast looks like weaker than the street had figured. They see Q1 revenue of 228. Estimate was more like 235.6 million. And then for the year, they're looking for revenue of 1.01 billion. The estimate on the street was close to 1.03. Came under a bit of pressure.
Yeah, I was looking at some commentary from the Baird analyst, Shrenik Kothari, who says the results were mixed, the outlook was below, and says that management talked about economic and political uncertainty continuing to affect budgets, timing, and business decisions. But of course, on the flip side, there's the growing adoption of AI, data, and cloud. So sort of that mixed weighing on the company. The stock is down some 30% or so over the past 12 months.
Yeah, down this year and over the past 12 months. It's been rough.
And then let's talk Polaris. That's our next trending ticker. That stock's been down as much as 7% today, following the recreational vehicle maker's Capital Markets Day presentation after the bell on Wednesday. BMO analyst Tristan Thomas Martin saying management, quote, struck a cautious tone here. And again, this is another company, so many of these consumer-facing companies bringing up the issue of the macro environment, the issue of tariffs affecting consumer sentiment, and this appears to be one of them as well.
Yeah, BMO did maintain the market perform. Their target's 50. Looks like the average target on the street on this one is more like 54. Most on the street still a neutral here. The stock, not good. It's down about, looks like 50% over the past 12 months.
Well, coming up, imported wine, champagne, and other alcoholic products from the European Union, the latest targets of President Trump's tariff threats. We'll get you more details and the latest from D.C. on the other side. Stick around, much more market domination still to come. Our next guest just returned from China, where he says government and business leaders are warning of rising tensions with the United States, but remain hopeful that a deal is still within reach. However, he says there's no doubt that if negotiations fail, the nations are on the verge of another full-blown trade war. Joining us now, Myron Brilliant, DGA Senior Counselor. Thank you so much, Myron, for being here. Obviously this trade war, tariff tensions are existing now on multiple fronts. And the Chinese front actually seems to be a little quieter at the moment, at least. Why do you think that is? And is this just a precursor to more tensions?
Well, Julie, I think there's a number of factors. I think that President Trump really wants to try to get some deals from China, dealing with fentanyl exports to the United States, dealing with excess capacity in areas like steel and certainly solar and other areas, autos. So the precursor is that he believes he can do business with President Xi Jinping, and so he's giving space. But we have increased tariffs, right? We've gone from 10% to 20%. So there is still that looming over the U.S.-China dynamic. But now they're talking about getting together, maybe April, maybe June. There have been different reporting out on that. But I think there's no question President Trump has the intentions of seeing if he can get some kind of deal. I don't know if it's going to be a grand deal, but some kind of deal with the Chinese. And I think he's setting that up. At the same time, he is still pursuing an activist trade and tariff strategy, right? We see that with the Europeans. We see that with Mexico, Canada, and we are seeing that with China.
Myron, you mentioned fentanyl. I want to circle back on that because that is top of the agenda. Trump obviously thinks about that a lot. He emphasizes that a lot. What can Xi do on that point specifically?
Well, Josh, I've been traveling to China for 30-something years, 100 visits. I can tell you, if the Chinese want to crack down on fentanyl, they can do that, right? And they can take measures at the border. They can crack down on the criminal syndicates in China. They can be more active in that. And that's no question that China has done that in other areas. They cut down on pirating of product when they saw it in their self-interest. So I think the expectation should be raised by President Trump on Chinese exports. And I think that's what he's doing. Now, the other side of the coin is you got to create a window where China feels like there's some give and take here. It's a win-win proposition in their view. So something has to give on the U.S. side in terms of the approach that President Trump takes, the rhetoric, the tariff imposition, all that. So Do I think something can get done on fentanyl? Absolutely. Do I think the Chinese can be stricter in their enforcement, crack down on the criminal syndicates? Absolutely.
Myron, I guess I would ask, the approach of President Trump this time versus the first term has been much more confrontational and adversarial. Do you think that China will escape that because of the relationship between Trump and Xi, because of their history? Do you think there's something specific to Canada, Europe, for example, that's created that? Or do you think this is just his blanket approach this time?
Well, I think President Trump believes that tariffs are not just a tool in the toolkit to get short-term wins, whether it's dealing with fentanyl or border security issues with Mexico and Canada or other issues that he's trying to achieve short-term. I think he believes it's a way to raise revenue. I disagree with the approach. I think it's counterproductive. I think it's going to create some down the road inflationary pressures. I don't care what the data shows in February. I think if you keep putting tariffs on with our allies and with countries around the world, you're going to increase inflationary pressures. You're going to see retaliation. We've seen that from the Europeans today. We'll see that increasingly as we go forward with potentially reciprocal tariffs measures. So I think it's a dangerous game to play. And I think it's risking what is otherwise a pretty strong economy. Business is strongly behind the president's agenda on taxes, on deregulation, on energy growth. So there's a lot to say about the agenda that business likes. This one issue is a hot potato. Right now, we're doing tariff volleys, but as it proceeds, this could become tariff wars, and there'll be a lot of retaliation. I think countries are much better prepared this time than they were in the first term to respond, and they're responding pretty aggressively. We've seen that in Canada from a particular premier and Ontario. We've seen that from the Europeans. We've seen that across the board. And I think China is better prepared. They've already mitigated the risk of exposure in the U.S. market by looking at other markets, increasing their production and investment in other markets in the last 7-8 years. And that trend is going forward. Just like we in the United States are seeing us do the China plus one strategy, now China's doing the U.S. and West plus one strategy. And in the end, that decoupling is not going to help the global economy, and it's not going to help our economy.
Myron, let's end here with your thoughts on technology, because China, of course, wants to become a global tech powerhouse. Washington, and this is bipartisan, would prefer they not be. How do the two sides navigate that dynamic?
Well, it's the most complex issue in the U.S.-China relationship. It touches on core national security considerations. Certainly, the United States needs to have some kind of a high fence garden around our tools, right? Our jewels that are designed to protect and innovate in our society, whether it's defense oriented or super chips, whatever you want to talk about. But the bottom line here is that we still can have areas where the United States and China can do business. We need guardrails. And that's what I said in the articles I put online on Time. What I said is very clearly that there are guardrails, there are safe zones where we can do business. There are also areas where we need national security protections. And certainly we've seen this in the field of data. We've seen this with super chips. We've seen this obviously with advanced computing. And that's going to be the difficulty in the U.S.-China relationship, because we're accelerating a decoupling from China in the tech space, and China is evolving its self-reliance policies, and they're in conflict. And we're going to have to figure that out through these negotiations.
My big
We got
topic.
a limited window, a very limited window to get something done before we see, I think, increasing tensions spill over into trade areas, not just in the tech field.
Myron, great to have you on the show today. Thanks so much for your time and insight. We appreciate it. There is a lot of talk about America's place in the chip race, but many differing opinions about how to establish dominance. President Trump taking a hardline stance with tariffs and a repeal of the CHIPS Act, but his approach isn't gathering a ton of support in Washington, even among Republicans. For more, Christopher Miller, professor of international history for the Fletcher School at Tufts University and author, of course, of Chip War. Chris, it's good to see you. So President Trump addressing Congress last week, CHIPS Act did come up, Chris, as you saw there. Our president did not have many nice things to say, Chris. He called the law, let me get this straight, it's a horrible, horrible thing. You should get rid of the CHIP Act, he told Speaker Mike Johnson. How does this evolve, Chris? What does happen with the CHIPS Act from here?
Well, I think you've seen from Congress more support for the CHIPS Act than the president has evinced, certainly. And I think Congress is ultimately going to be responsible for making any major changes to the CHIPS Act. The administration has some flexibility to tweak some of the grants that have been made to chip companies, but for big changes, that would require Congress. I think Congress is probably unlikely to make any big moves on this issue. I think instead the White House has signaled it's going to focus on tariffs as key to the president's strategy. We've already seen tariffs on China, for example, on Mexico and Canada. And the president's repeatedly said that semiconductors are one of the spheres where he wants to impose tariffs. And I think the industry is looking somewhat nervously at that because the scope of tariffs is unclear, but the impact on the industry would be significant.
Well, and of course, there are existing tariffs, there are existing export controls on chips from China right now, Chris. What effect has that had thus far on the U.S. position vis-a-vis China when it comes to the competitiveness between the two nations in that area?
Well, if you look at the tariffs the U.S. has today on chips, they are only on chips imported from China, and very few of the chips that the U.S. actually uses are imported from China. It's one of the spheres where actually Chinese firms still haven't caught up to the cutting edge, and as a result, we don't buy that many chips from China. But if you started imposing a global tariff regime that hit semiconductors, tariffing Taiwan and Korea and Japan and countries in Southeast Asia, that would be a lot more disruptive because those are the countries that we import larger volumes of semiconductors from. And so for manufacturers in the US, like automakers, medical device manufacturers, they're importing chips from other countries. Currently, they face no tariffs, but they're certainly, I think, watching closely to see whether the president increases tariffs on those semiconductors. And the question is going to be, are there alternative supplies in the US? Sometimes the answer is yes, but often the answer is no, because we only produce certain types of chips and other countries specialize in different capabilities.
I want to get your thoughts, Chris, about another headline we talked a lot about. These reports that TSMC pitching NVIDIA, AMD, and Broadcom about taking over Intel's chip manufacturing operations. And this sounds like what would be discussed here is kind of a joint venture. I'm curious, Chris, to get your thoughts on that. And can you imagine that deal ever getting done and being structured in a way that, yes, would get President Trump's approval?
I think there are a lot of questions hanging over these discussions. They've been underway now for a number of months in the public sphere. But I think some of the questions that are being posed are, first off, what are the economics that would make this a viable deal? TSMC doesn't need Intel. It's already got a highly profitable business. So it's not immediately clear what TSMC would get from this. And from Intel's perspective, they're a competitor with TSMC. And so a joint venture would really change the relationship between those two companies. And finally, from the perspective of the United States, having competition at the cutting edge is, I think, a strategic priority for the U.S. government, and having high-end manufacturing in the U.S. is also a strategic priority. And any sort of joint venture that blended the two firms' technologies would, I think, raise questions in Washington about whether the U.S. was retaining the manufacturing capabilities and the R&D capabilities that the U.S. government would want to have see. So I think a lot of questions around these rumors, and Intel, of course, just appointed a new CEO yesterday, so we'll have to wait and see what he says about his company's strategy.
Well, and some of the early indications have been that he's going to stick with this merchant foundry strategy. That is Intel going ahead with its plans to make chips for other companies. Right now, it only makes chips for itself. I guess at this point, do you think that strategy is viable? Right? That's been sort of the main question around Intel. Is it going to be able to achieve this and have the manufacturing capacity and ability to make chips for other companies?
Well, I think there still are a lot of questions around that strategy right now, both in terms of will it work and also over what time horizon will it need to develop. The challenge is that, of course, it takes a lot of money to build out these factories, and the time it takes to build them out is also substantial. So raising the funds needed is something that would be a challenge for any company, but especially, I think, a challenge for Intel, given that it's lost credibility with a lot of its investors over the past couple of years. And I think front and center on the new CEO's plate will be restoring that credibility and setting out a business plan that investors are willing to get behind, because they need to be behind it, given the capital intensivity of the investments that Intel plans to make.
Right. Chris, it's always great to get your perspective. Really appreciate it.
Thank you.
Well, you might need to say goodbye to some of your favorite adult beverages. President Trump took to Truth Social to threaten a 200% tariff on European wine, champagne, and other alcoholic products if the EU did not remove a 50% tariff on American whiskey. Joining us now, Yahoo Finance's Brooke De Palma to talk to us about what. Now, again, it's just a threat. It's not in effect yet. But how should we think about we buy a lot of booze from Europe. They probably buy a lot of booze from us too.
Right, they buy a whole lot. In 2024, U.S. actually imported $5.4 billion of wine from the EU, $1 billion of beer, and $3.5 billion of spirits. When you take this all together, that's roughly $10 billion worth of alcohol imports from the EU. Now, Needham and Company analysts told Yahoo Finance that a potential tariff, that is, of a caliber of 200% would essentially eliminate imports of these types of products. He said, quote, a company is not going to ship it on a 200% tariff. It increases the likelihood that you're going to get a global trade war with collateral damage, and that's not going to be good for the sector. Now, shares of Pernod Ricard are falling today based upon this potential threat that President Trump took to social media touting. Now, the company did refer, that's Pernod Ricard, did refer to a trade group statement that Spirits Europe. He said, or rather the company, this trade group said that it is deeply alarmed by the renewed threat of tariffs on EU and U.S. spirits. Once again, it said that it's being a part of an entirely unrelated dispute. Now, this trade group, Spirits Europe, went on to say the cycle of tit-for-tat retaliation must end now. Now, to be clear, the tariff on American whiskey to the EU is still set to go into effect on April 1st as part of that retaliation for U.S. putting a 25% tariff on steel and aluminum. And a spokesperson from Brown-Forman did tell Yahoo Finance that they're pleased that the European EU President and Trade Commissioner expressed a desire to negotiate with the U.S. and hoping that they do come to this resolution by April 1st. Of course, that is looming rather quickly, but they went on to say that this tariff conversation is much bigger than just one company. It is a multitude of different companies that are really going to be hit by these potential tariffs.
It's going to be really interesting to see what wine sales look like over the next month.
I mean,
or over the next couple of weeks,
200%. This analyst that I spoke to said that there could be like a stockpiling. I mean, people might be rushing to the store as we chat right now just to get their hands on that already very expensive French wine and champagne.
It's not all that expensive.
Worth it, maybe.
Well, it doesn't go bad.
Exactly.
So, yeah.
Thank you, Brooke. Appreciate it. In the Yahoo Finance podcast, Warrior Money hosts Patrick Murphy and Dan Coons help fellow veterans navigate the transition from the military to the business world. Scan the QR code below to stay updated on the latest. And don't forget to tune in every Friday at 12:30 p.m. Eastern. Here's a clip from this week's episode.
The most unexpected part, I guess it's that I got to, in some ways, live out the dreams that I had when I was a kid. So I was inspired by so many coaches, teachers, mentors. I read books, I watched movies, I talked to people, and now here I am in New York City with you guys on Yahoo Finance talking about Warrior Money and to be able to be here. It's these kind of special moments that were the most unexpected part that I kind of got to where I was hoping to be, and here I am talking to you all.
Amazon, Meta, and Alphabet's Google signed a pledge Wednesday to triple the global nuclear power supply by 2050. The tech giants adding their names to the World Nuclear Association's Large Energy Users Pledge. That envisions at least tripling global nuclear capacity from current levels by 2050. Nuclear energy currently provides around 9% of the world's electricity. Joining us now, Mark Nelson, Radiant Energy Group founder. And I imagine you've been talking a lot about nuclear over the past few days because you're at CERAWeek, which is a big oil and gas and energy conference, Mark. I think the questions remain around nuclear in terms of where that capacity is going to come from, since nuclear is sort of notoriously expensive and takes a long time to get capacity up and running.
So the fourth nuclear plant you build of the same design doesn't take so long historically. What we're trying to figure out is who on Earth needs 4 nuclear plants or 4 reactors of the same design or 8 reactors, depending on how much power we're talking about. That's enough power for 8 million people. What's different here is that before, the giant energy users didn't necessarily think nuclear was a solution. And this year at CERAWeek, with the pledge to triple nuclear by 2050, we can see that we have millions of people's worth of AI center demand and even just growing economies willing to bet that nuclear is the way forward if they join together and get the orders in bulk.
I'm curious, Mark, what role you think the U.S. government can and should play in this market in terms of regulation, Mark, and in terms of just generally encouraging nuclear expansion. How do you see sort of Uncle Sam's role here? What role can he play in a positive way?
Well, most of what we've heard of so far has been about the role of getting out of the way. A lot of folks claim that they can make new, innovative, or smaller reactors if there's less regulation. We're seeing action in that area. What's less understood is that almost all reactors being built today, including almost all of them in China, almost all by Russia, they're the large reactors that we already have licensed and already agree can be placed at existing nuclear plants. The role the government can play there is one of supporting the efforts to deploy at scale. It really is about getting the first ones in, and whether that ends up being some kind of loan guarantee or the Department of Energy stepping in and saying, hey, up to this level, American people will back you to this much if you pay us back later. That's the type of thing that historically has led us to make big nuclear investments. What's different this time is we haven't had both the government policy and the major demand from the world's biggest energy users at the same time.
Right. In this case, the hyperscalers, which want that sort of powerful, steady supply of energy. I think for investors, Mark, what they're trying to figure out is how does one play this, right? Because you do have the big power generation companies, the Exelons, the Dominions, the Constellations of the world that own the nuclear plants. Then you have some of the upstarts that aren't going to have anything up and running, if they even end up having anything up and running, for several years yet. So how should people be thinking about sort of the investment opportunity potentially?
As soon as the market heard about the AI boom and they realized that only a few companies in America own a bunch of the nuclear plants, those utility stocks of existing nuclear, they popped. It's since gone up and down based almost entirely, as far as we can tell, on AI sentiment. So here's the thing. The question we had coming into this conference is, these giant utilities, were they going to move first? Were they going to take the risk of constructing nuclear? We've gotten an ambiguous answer. A bunch of these big utilities have said, we won't go first, but we might go second. What they're signaling to Wall Street is, we're not going to waste your money with experimental efforts, but we know that Wall Street is valuing our companies, our utilities' future, based on how much power, steady power we can provide of either gas or nuclear. So here's what we're looking for. You mentioned the upstarts. That can be both utilities that don't have any nuclear anymore because they sold it at the bottom, or utilities that are thinking of getting into nuclear for the first time. I see maybe bold moves coming together when you see these group efforts where you may have demand from a hyperscaler, interest in operating and owning a nuclear plant from a utility, and then you have new developers that are coming along to merge it all together and get a group order to build the same way every time. Designed once, licensed once, built many times by an experienced crew. That's what you have to look for before you think it's the utilities themselves that are probably going to build enough nuclear power to affect the bottom line, or to take a risk of the bottom line of investing in what to them has been a risky new technology.
I'm also interested, Mark, just in the geopolitics of this, when it comes to civilian nuclear technology, nuclear energy. Where is China in this discussion?
China builds their best design, and China builds our best design. So China builds copy after copy after copy of these large reactors, and China's building the smaller prototype reactors that so many people have been talking about. The smaller prototype reactors, they're going to be pretty cool tech. They might expand. They'll be anywhere from 1% to 2% in the short run to maybe 5 to 10% or 15%, depending on whose opinion you take. The large reactors, that's going to be 90, 85% of their total electricity capacity. The stuff like when President Trump is talking about dominance, he means the 1 million people at a time, or 3 giant data centers at a time reactors. They're building those over and over because they bought licenses from America, from France, from Russia, from whoever they can get, and then they started building and they didn't stop. So they're in practice. They don't have any crazy technology or anything we can't recreate. They don't even have super cheap labor anymore. And they are working on their own designs, but for now, if we can decide to build reactors over and over like they do, we're going to be able to unlock those cost reductions that we've seen everywhere that has survived the blowout of the first unit or two that is so famous and stopped the nuclear revolution the last time it happened.
Mark, great to see you as always. Thanks for joining us.
Good to be here.
While wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.